Long-term wealth preservation, structuring capital for a multipolar world. Section 1, Introduction, Preservation over Performance. For decades, investing has been framed as a race. Outperform the market, maximize returns, compound faster than everyone else. Performance became the metric. Alpha became the trophy. Volatility became tolerable so long as the long-term average looked attractive on paper. But long-term wealth preservation operates under a different logic. It is not about maximizing upside. It is about minimizing irreversible damage. The first rule of investing, rarely practiced with discipline, is not to lose money in permanent terms, not nominally, not emotionally, not structurally. Preservation recognizes that compounding only works if capital survives. A 50% drawdown requires a 100% recovery. A confiscatory tax regime permanently reduces base capital. A custodial failure can erase ownership overnight. Preservation is not passive, it is architectural. And in a multipolar world, where power is distributed across competing economic blocs, monetary systems are politicized, supply chains fragment, and tax regimes evolve, the architecture surrounding capital matters more than ever. This is the central thesis. Long-term wealth preservation is not an asset allocation problem. It is a systems design problem. The investor is no longer simply choosing between stocks and bonds. They are choosing between jurisdictions, between tax frameworks, between custody structures, between liquidity models, between geopolitical trajectories. In such a world, wealth must be structured, not merely invested. Section 2, the preservation principle. Preservation begins with clarity about risk. Volatility is not the enemy. Permanent impairment is. Markets fluctuate, prices move, gold falls 30%, equities fall 50%, Bitcoin falls 80%. These are temporary expressions of repricing. But permanent loss occurs when capital cannot recover because it has been taxed away, diluted away, confiscated, misallocated, or structurally destroyed. Preservation thinking distinguishes between nominal returns, what statements show, real returns, what purchasing power retains, after-tax returns, what you actually keep. Inflation is the silent adversary. It erodes purchasing power gradually, invisibly. A portfolio that grows at 5% while inflation runs at 4% is barely compounding at all. Add taxation and fees, and the real return may approach zero. The mathematics of compounding is unforgiving. Small annual drag compounds into large long-term reduction. A 1% annual friction over 30 years meaningfully alters terminal wealth. A 20% tax at exit permanently reduces principal for future generations. Preservation therefore shifts the lens from how high can this go to how resilient is the base, how much friction exists, how protected is purchasing power, how reversible are losses. The objective becomes durable compounding, not spectacular performance. Section 3, the tax drag variable. One of the most underappreciated forces in long-term preservation is tax drag. Taxes are not a one-time event. They are a compounding variable. Dividend taxes, interest taxes, capital gains taxes, inheritance taxes, wealth taxes in some jurisdictions. Each layer reduces the reinvestable base. Over decades, this reduction compounds. An asset that produces 8% annually but leaks 2% to tax and 0.5% to fees is not an 8% asset. It is a 5.5% asset. Over 30 years, that difference is transformative. This is where structure matters. Some jurisdictions operate on worldwide taxation, taxing residents on global gains regardless of where assets are stored. Others operate territorially. Some impose no capital gains tax at all. Some offer long-hold exemptions. Some create special treatment for specific asset classes. The difference between tax deferral and tax elimination is profound. Deferral delays the friction. Elimination removes it from the equation entirely. In long-term preservation, removing friction is often more powerful than seeking additional yield. This reality also explains why non-yielding assets, such as gold, can be structurally efficient in certain tax environments. They do not generate annual taxable income. They allow compounding to occur quietly without leakage until disposition. But taxation is not just about rates. It is about residency, reporting obligations, legal clarity, and regulatory stability, which leads to the next structural layer, asset selection inside a defensive framework. Section 4, asset selection in a defensive framework. Once preservation is defined as structural resilience rather than performance maximization, asset selection must be evaluated differently. The question is no longer, what grows the fastest? It becomes, what survives regimes? Gold, monetary insurance. Gold has endured every monetary regime change of the modern era. It has survived empires, fiat resets, debt crises, and currency collapses. It produces no yield. It generates no cash flow. It has no chief executive officer, no balance sheet, no earnings report. And that is precisely its function. Gold is not an income instrument. It is monetary insurance. In inflationary regimes during systemic distrust or amid currency debasement, gold preserves purchasing power when paper assets falter. Over very long time horizons, it tends to track the expansion of monetary bases globally. It does not compound aggressively, but it resists decay. For preservation, this matters. However, gold has long flat periods. It can underperform equities for extended stretches. It requires patience and conviction. It must be understood as a defensive asset, not a growth engine. Bitcoin, asymmetric hedge with volatility. Bitcoin represents a newer form of monetary hedge, digital scarcity rather than physical scarcity. Its historical performance has been extraordinary, but its volatility has been extreme. From a preservation standpoint, Bitcoin poses a paradox. It has outperformed nearly every asset class since inception. It has experienced repeated drawdowns exceeding 70%. For those with sufficient time horizon and psychological tolerance, it may serve as a hedge against fiat debasement and monetary experimentation. But it cannot be treated as low volatility preservation capital in the traditional sense. Position sizing becomes critical. Bonds and equities in a taxed environment. Equities have historically delivered superior real returns over long periods, but they come with earnings risk, regulatory risk, valuation risk, tax leakage through dividends and realized gains. Bonds offer stability, but are vulnerable to inflation and rate cycles. In high debt, high inflation environments, long duration bonds can produce negative real returns for extended periods. In preservation architecture, these assets are not discarded, but they are evaluated within tax, inflation, and regime risk constraints. The defensive framework does not eliminate risk. It attempts to distribute and structure it intelligently. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. Custody architecture. Ownership matters. Asset selection is only half the equation. How an asset is held often matters as much as what is held. In the case of precious metals, this distinction becomes critical. Allocated storage, specific bars or coins held in your name, legally segregated. Unallocated storage, a claim on pooled metal, subject to counterparty risk. In preservation thinking, legal clarity and title integrity are paramount. Questions must be asked. Do I hold direct title? Can the asset be rehypothecated? Is it insured against all risks? Is there independent audit verification? What jurisdiction governs the custody agreement? History shows that custodial structures fail more often than assets themselves. Fees also matter here. A 0.3 to 0.5% annual storage fee may appear small, but over 30 years it compounds. Yet compared to annual tax leakage or counterparty loss, it may be an acceptable friction. Preservation requires choosing the friction you accept and eliminating the ones you can. Section 6. Liquidity without liquidation. A key insight in long-term preservation is the value of liquidity optionality. Selling an asset to raise cash may trigger capital gains tax, loss of future upside, market timing risk. Collateralized lending provides an alternative. By pledging a hard asset as collateral, one can access liquidity without disposing of the underlying position. The asset remains owned. The potential appreciation remains intact. The tax event is often avoided because no sale has occurred. This introduces new considerations: loan-to-value ratios, margin call thresholds, interest cost relative to opportunity, counterparty reliability, legal enforceability. Used conservatively, collateralization can preserve structural integrity while enhancing flexibility. Used aggressively, it can reintroduce leverage risk, the very force preservation seeks to avoid. Optionality is valuable. Leverage is dangerous. The difference lies in discipline. Section 7. Jurisdiction as a strategic asset. Perhaps the most underappreciated layer in preservation architecture is jurisdiction. Most investors think globally but remain taxed locally. In worldwide taxation regimes, residents are taxed on global gains. Storage location does not override residency obligations. In territorial regimes, foreign source gains may escape taxation. In some jurisdictions, capital gains tax does not exist at all. Beyond tax, jurisdiction determines property rights enforcement, rule of law, political stability, regulatory predictability, reporting obligations, capital controls. In a multipolar world where economic power is diffusing across the United States, China, Europe, and emerging blocs, jurisdiction becomes a strategic allocation decision. Capital naturally migrates toward legal clarity, tax neutrality, financial sophistication, geopolitical stability. The choice of where capital resides may influence long-term outcomes more than the asset chosen. Jurisdiction is not simply geography. It is policy risk exposure. Section 8. The preservation stack. If preservation is a systems problem, then it must be structured in layers. Think of it as a stack, each layer interacting with the others. Weakness in one layer compromises the entire structure. 1. The asset layer, what you own. This is the visible layer. Gold, Bitcoin, equities, bonds, real assets. Each carries a different inflation profile, volatility pattern, correlation structure, and regime sensitivity. The asset layer answers, does this protect purchasing power? How does it behave in inflationary versus deflationary regimes? Is it dependent on counterparty performance? Is it politically vulnerable? But asset selection alone does not ensure preservation. 2. The jurisdiction layer, where you are taxed. This layer determines the long-term friction. Worldwide versus territorial taxation, capital gains treatment, wealth and inheritance exposure, regulatory stability, exit tax considerations. Two identical portfolios can produce radically different long-term outcomes depending on residency. A high-return portfolio under a high-friction tax regime may underperform a modest return portfolio in a friction-minimized structure. Preservation demands clarity here. 3. The custody layer. How it is held. Ownership without control is an illusion. Allocated versus unallocated metal. Exchange custody versus self-custody in digital assets. Rehypothecation risk, auditability and insurance, legal enforceability. In a crisis, custody terms matter more than theoretical valuation. Preservation asks, can I access what I legally own under stress? 4. The liquidity layer, how you access capital. Capital that cannot be mobilized becomes inert. The liquidity layer includes collateralized lending structures, loan-to-value discipline, margin mechanics, interest cost management, timing flexibility. The objective is optionality, not leverage-driven amplification. Liquidity without forced liquidation preserves structural integrity. When these layers align, asset resilience, tax efficiency, legal clarity, and liquidity flexibility, capital begins to compound without friction. When one layer fails, the entire architecture weakens. The preservation stack is not about maximizing returns. It is about minimizing structural fragility. Section 9. Risks and constraints. No preservation structure is immune to risk. Designing for resilience does not eliminate uncertainty. It reduces exposure to predictable failure points. Regulatory shift risk. Tax regimes change. Capital controls emerge. Reporting requirements expand. Preservation requires periodic reassessment. Political and sovereign risk. Even stable jurisdictions evolve. Stability today does not guarantee stability in 30 years. Diversification across jurisdictions may itself become part of the stack. Storage and operational risk, vault integrity, counterparty solvency, digital custody security. Operational diligence is not optional. Opportunity cost. Defensive positioning may underperform during extended growth cycles. Preservation is rarely the highest return strategy in euphoric environments. But preservation is not designed for euphoria. It is designed for endurance. The investor must choose between maximizing upside in calm waters and ensuring survival in storms. Conclusion: designing for survival, not speculation. In a unipolar world with predictable monetary policy and stable global trade, asset selection alone might have been sufficient. That world is fading. We now operate within competing monetary blocks, rising sovereign debt burdens, policy-driven currency experimentation, geopolitical fragmentation, rapid technological change. In such an environment, preservation is intentional architecture. It is the deliberate alignment of asset selection, tax positioning, custody structure, liquidity strategy, jurisdictional stability. The objective is not spectacular performance. It is durable compounding. It is purchasing power retained across decades. It is sovereignty over capital. Long-term wealth preservation is therefore not defensive in spirit. It is strategic. It does not chase opportunity. It survives transition. And in a multipolar world, survival is compounding.